Hello, hello, hello. My name is Rosalind Brown, and I am your wealth guidance. I want to welcome you again for another Great Money Monday. As you know, each week we bring you great actionable items that you can implement on your own financial independence journey. So, as usual, we have a phenomenal speaker who is here to share some tidbits as you're planning out, as you're structuring and figuring out what next for your journey. And so, as we talk about life insurance, oftentimes people are thinking about just one way to use life insurance. But today we have Miss Sharon Jennings. She is an entrepreneur, wife, mother of two beautiful and handsome men, and philanthropist. Sharon has over 20 plus years in the banking and finance industry and 8 years in the health industry. It is her mission to bring healing, guidance, and education to Middle America, the community, and small businesses alike as it relates to life insurance. Wealth strategies and achieving financial freedom are also big goals of Sharon's. Sharon has continuously studied and trained to stay current on the principles and trends of personal finance and wealth accumulation. So, without further ado, I just want to turn the mic over to Ms. Sharon Jennings. Please give us your great gems of the evening.
Perfect. Awesome. Thank you so much for that marvelous introduction. I'll have your check in the mail soon. Thank you. So, yes, again, as she stated, I am Sharon Jennings, and I am just so excited and elated to be here to share the wisdom that I have and that I've learned with you all over the past 20 plus years. So I'm excited, and thank you guys for coming into Money Monday. So let's get started here. All right. So, what we're getting ready to discuss with you all is just our approach to your family banking and how it can definitely make a difference in your life as it relates to the new life insurance. Life insurance that you don't have to die to use, life insurance that can also assist you and your family with learning more about how to manage your day-to-day finances in the world today. So we are going to get started and just give you some things to think about as we go along, okay? So let's start. If I were to say or ask you, are you 100% sure that you're going to have a great retirement, or do you have some doubt? What will your answer be? So ponder on that as we go through these slides, okay? And then if I would ask you, well, I tell you what if I could help you or could show you how to get out of debt in 9 years or less, including your mortgage, without you spending any additional monies than you're currently spending right now? So that's what we're getting ready to just kind of go into this program or into this approach for you, okay? The average American household basically pays out anywhere from 23% for their lifestyle, 34% in interest, 40% in taxes, which is only going to leave you about maybe 3% that you're able to even save for things that are going to come along in life. About 40% of every dollar that the average American earns goes out to taxes. I'm talking about everything from income taxes, taxes on water, gas tax, sales tax, etc. So that leaves, like I said, about maybe 23% that you're going to have for lifestyle. And that's money that you're going to basically have left to live off of. Okay. This is why it's called lifestyle money, because that's what you have to live. That's what you're going to live by, and that's what you're going to live off of. That's why we pay everything else, and that's what we'll have everything else to pay with. It's just that little bit. And then like our car insurance, our gas, clothes, etc. Again, so most advisors are going to tell you, well, let's concentrate on that 3% that you have left, right? They want you to basically, I don't know, live off of beans and water and bread, instead of giving you the opportunity to say, let's kind of figure out where and how we can change this around. Let's get Mr. Taxes and Mr. Interest out of our pocket so that we can increase that. Okay. The average household debt, you're looking at about $250,000. The Your Family Bank approach to this comes into where we are going to be able to save you and to change the way that this is going to look for our families. We're looking at decreasing that interest anywhere to about from 34% to 22%, decreasing your taxes anywhere from 40% to 33%, thereby increasing your lifestyle so that you can pay those other things that you have to live off of. Also increasing your savings in the interim. So that's what we're here, and that's going to be the approach that we're going to help you with. And there are 7 steps that we're going to go through to help you guide you through this process and basically present you with a roadmap to help you understand how and why we're here to assist you as we go along the way. All right. So like I mentioned, 7 steps that we're going to go by. The first step is knowledge. We have knowledge about all sorts of other things, sports, web design, cooking, cars, etc. But to retire well, we really need to know the rules of money and how money works. Okay. Knowledge only becomes power when we put it to use. Okay, so that's our first step, is just to bring you into the knowledge, to educate you more on how this works. Okay, and then what if we could teach you how to basically reduce the volume of interest that you're paying to lenders, get out of debt in 9 years or less, improve your cash flow, decrease taxes, save for college, retire with tax favored income. Well, those are the things that we're here to help you do. Okay. We're in this thing called the game of life. You guys remember that game, the game of life? It's like, why do you feel, or why do we feel like every step forward, we take 2 steps backwards? Well, that's the game of life, basically. You know, we have our cars, the house, vacations. We want to go on vacations, the debt, the credit card debt, school, education. All of those things comes into play when we're speaking of life. All right. The total assets at the age of 65, by the time we reach that age, the average American would have had about $2 million to go through their hands. Right. And we're speaking of the American dream. You know, we get to age 65, we want to retire. Somebody told us that we needed to retire at 65. Okay. But what we need to realize and understand, to be retired means to be unemployed. So we want to make sure that we have those funds set up for us so that once we retire, we can do just that, be unemployed. We don't want to have to go back to work unless it's our choice to do so. So let's just talk about this $2 million. You know, by the time we get to age 65, the truth of the matter is, because we were not educated, we end up with about $60,000 at retirement. You know, and we help people to understand the fact of when we're speaking of a 401k and things of that nature, your 401k, your TSP, your, you know, all of the acronyms, all of those or postponed pre-tax dollars are simply postponed, which basically means they've been deferred, and you're at some point you're going to have to pay them. And now we find that, okay, out of this $2 million, here's where we are. That's not the American dream. It isn't. Okay. So step 2 of our step 7 approach is cash flow. When you know where your money is going and you track it, you control it. The person that has the money controls the game. Remember Monopoly? So those are the things that we kind of want people to understand and to get this, you know, so that we can help them track the money, control your money. All right. We even provide our clients with the spending planner. Just look for ways to help you save money to become more efficient. We basically go through and help you find the inefficient dollars that you're throwing away unknowingly and unnecessarily. We show you how to redirect those funds and where to park those funds from this point. Plan for the unexpected as well as the expected. The 80-20 rule, and we're not talking about a man or a woman. Okay, so with that being said, the Your Family Bank Plan in our strategy, we strategically designed this for life, for real life incidents. So basically, you have your 80/20. Your 80% are the things that you plan for. And then you have your 20%, the unexpected things such as emergencies, right? Or, you know, emotional spending. So that's going to be your 20%. Your 80%, again, that's your long-term things, your day-to-day things that we have to deal with in life. Your 20%, emergencies, emotional spending. We've all done it. We get off of work, we're hot, we're bothered, we want to go to, I don't know, Starbucks or somewhere. Emotional spending. We account for that. Whereas other advisors are basically going to tell you, no, you can't do this, you can't do that. But that's not how we live life. We want to be able to do things. We want to be able to live and to have fun with and enjoy the fruits of our labor. So we basically strategically, show you how to design a roadmap and to plan for those things that are going to come up. You see a purse in the store, you want to be able to buy it, plan for those things, not telling you just to go out and spend your money any kind of way, but at least we know that those are things that we have accounted for. A gentleman may want to go out, he ends up at the car dealership, he's looking through pamphlets, and before you know it, he's driven off the lot with a brand new car. So we know and realize that things like that are going to take place. So again, we strategically design our plans to help our clients with that, keeping that in mind. All right. So let's just say this, you understand, and we all know that a bank is definitely a business. And what we mean by this is we want to show you how to redirect your funds, where we teach you how to become your own bank. Okay. So we know that a bank is a business. And for example, if you were to go to a bank, take $10,000 to deposit it into that bank. We want you to realize and be able to understand how the banking industry works so that you, again, can become your own bank. Know that and teach you how to make every dollar that you use or that you make, you're able to use it at least twice. We want you to be able to do the same thing that a bank does. Okay. So let's just say, for example, you go to the bank and you take $10,000 and you deposit it into the bank. They are able to take that very $10,000 and dispense it out 7 times over, loan it out. We want to teach you how to do that, and you become your own bank again. Use your dollar, create compounding interest for yourself. Okay. You take that same $10,000 that you just went to the bank with, they may give you, I don't know, maybe 1% if they're generous, right? You go back the next day and you tell them you want to take a loan out. They're going to say, okay, sure, Miss Client or Mr. Client, we need your name, your social security number. We got to run your credit. We got to see if you're even going to qualify. We're going to go through all the things. And then based on your credit, we're going to charge you anywhere from 4% to 29%. Right? But when you took your $10,000 to the bank, you didn't ask them for their credit, right? You didn't ask them what their FICO score was. You didn't ask them, what they were going to use the funds for. You just simply took it. And now that money is basically sitting there earning an interest. And like I said, that's if they're generous, 1%, simple interest. We want to show you how to use your money twice and earn interest, compounding interest on top of that. Okay. Teaching you how to become your own bank. Step 3, we're going to basically show you how to minimize your debt, creating additional wealth, right? So what we're going to do is we're going to go through and we're going to look at some actual clients of ours. Mark and Joyce, they're the typical American family. So Mark is 37 years old, Joyce is 35. Again, their desired retirement age is 65. Again, someone told them that they needed to retire at 65. Their monthly income is about altogether a little over $7,000 together. What they desire to retire with is $5,000. They have 3 children. One didn't make it onto the photo shoot, but they have 3. They have a 3-year-old, a 4-year-old, and an 8-year-old. College savings, they have none. We can help them with that. Their main areas of interest is to increase their retirement income, reduce their debt, get spending under control, college planning, and increase their savings. All the things of which we can help them with. So I'm going to introduce you to them and just look at their profile. So let's just take a look. Mark and Joyce, they do have a savings account. They have Bank of America is their savings where they pull up their money or park their money right now. They have about $6,000 in that account. They're contributing $25 a month with an interest rate of 0.25%. Okay. They have a Fidelity. They have a 401k account at Fidelity. They have about $36,500 in their account. They contribute $300 a month with about 5% interest. Okay. And where you're seeing the available for YFB, that's the Your Family Bank. And again, that's where we go in and we're finding monies that the clients are throwing away either knowingly or unknowingly, inefficient dollars. So that's what that available for YFB that you're seeing there. So we're going to help them redirect those funds. Okay. All right. And so let's look at their debt. Mark and Joyce, they have, and some of these things may look familiar to you guys because we all have them. We have Visa, 12% their interest rate. Their balance is $460, $55 minimum payment that they're making. Dental, other credit cards, furniture, auto, mortgage. Their total debt that they're paying on these bills is at least their balance is $180,000, $198. $180,000, Remember that number. Their payment is $2,177. That's their total debt that they're paying or payments that they're paying out each month with an average interest rate of 10%. Okay. So their debt summary, this is something that we're going to provide to clients that come to us. We show you again that real debt, or at least their total debt, what they thought was their real debt was $180,198. Their real debt, because of interest, we never think about this, is $380,157. That's the additional interest, $199,000 in interest that they would have paid over the next 30 years, because remember they had that mortgage, right? So again, total debt 180, a little over 180, real debt 380, over $199,000 in interest that we're not taking into account. Okay. So again, we're still looking at Mark and Joyce. Their current retirement plan, we're just revamping, was $36,500 in their retirement savings account. They were contributing $300 a month with a 5% annual interest rate. They were in their 25% income tax bracket. Retirement accounts, this is the end of their savings period at 30 years. Before taxes, $408,000, $890. After taxes, after they're taxed with it, they would be left with $306,668. Okay. Here's what we were able to help them with, because they came to Your Family Bank, and this is what we were able to do for them. By using the Your Family Bank method, Mark and Joyce were able to get out of debt in 7.8 years. We were able to free them from their lenders in 7.8 years. Okay. Save them over $122,000 in interest. Remember, we want to reduce and get Mr. Interest out of our pockets so that we can save that money and redirect those funds. We were able to free up that $2,177 a month and show them how to start saving that for their retirement. All right. And so in savings over the next 30 years, they were able to save $1 million, or actually over $1 million. Okay. So that again is what we are here in design for you guys, as far as our clients are concerned, to show them how to redirect their monies and make those inefficient dollars become efficient dollars. Okay. So again, their current plan after taxes for retirement, they were with $306,000, a little over $306,000. By using the Your Family Bank plan method, they were able to have over $1 million tax favored retirement. So let that sink in. So what if they decided that they didn't want to do anything such as the Your Family Bank, or learn how to become their own family bank by, getting compounding interest, having cost opportunities available to them? The risk of that, or them not doing that, would have cost them the $1 million in retirement, the $122,000 in the interest that we saved them. And then you take away their current retirement where they do have the $306,000, and that would have left them with a benefit loss of over $820,000. So that's the minimizing the debt. That's step 3. So step 4 is taxes. The less we pay, the more we keep. All right. So again, and we know every year there's a new tax law. So of course, we hope that you sit down with your tax advisor or your financial planner every year, and we hope that they, go over these things with you, because the rules do change. And hopefully they're keeping you informed with that. All right. And hopefully that they have you on the right path. If you don't have one, then I would suggest that you reach out to either myself or look for you one, because we definitely want to make sure that you're able to take advantage of these opportunities that presents themselves. So with that being said, if we look at the future tax rates, would we think that taxes are going to be higher, lower, or stay the same? Most people would say that they are going to be higher, because remember, they change every year. And so if we think taxes are going to be higher, is postponing taxes a really good idea? And postponing those taxes would be things such as like your 401k, because it's pre-tax dollars. It's postponed, it's deferred. So at some point you're going to have to do that. You're going to have to pay it. So when is a good time to start planning? Now. So let's just say let's just speak on that. If I gave you a business proposal, or if I have a business proposal for you, and I say to you, okay, you front all of the money, you take all of the risk, you manage the business on a day-to-day basis, and 30 years from now, I'll tell you how much you owe me. Would you want to go into business with me? I wouldn't. But that's exactly what we're doing when we're dealing with things, or dealing with accounts that are tax deferred or postponed. So we have to be mindful of that, because at some point the government is going to want their money. Okay, so I wouldn't do it. So let's just talk about the rule of 72, how money works. Okay, so with the rule of 72, and I'm sure you guys have heard of this, the rule of 72 is basically a formula that was created by the Census Bureau to tell us how long it would take for the population to double. So the banks and the financial institutions, they also thought about this, and they said, okay, well, if they can tell us how the population, or how long it would take the population to double, it should do the same for our money as well. So that's basically the rule of 72. So basically it's just, you're taking 72, and what you're going to do, and this is just some examples that we have here. You would take, if you had 3%, you would divide 72 divided by 3 is 24. So it would take technically 24 years for that person's money to double. Same thing as we go throughout the stock market and everything. So just keep those things in mind. That's the rule of 72. So here, I'd ask you guys, okay, are you sure? Do you know how an IRA would work? So I'm going to show you something at that. We found out that, let's just say if you were to put $5,000 in an IRA contribution at a 25% tax bracket, and remembering with the rule of 72, now that you know that, and we know that it doubles what? Every 7 years. Okay, so here we are with the rule of 72, and we're looking at this by the age of 45, you put in $5,000, at 10%. Age of 52 doubles. Here we are. We got our 7 years. Age 59, we're at 20. Age 66, we're at 40,000. So we're like, okay, well, let's look at the tax savings growth at that 10%. At age 45, $1,250. And again, we're in an IRA. 52, we're at 2,500. So it's just doubling. 59, 5,000. At age 66, 10,000, right? So if we're there and we get to that point with the rule of 72 and I'm at a 25% tax bracket, now you add all that up and I got my $40,000 at age 66. I multiply that by 25%, that's what? I'm now taxed at $10,000. So where's the tax savings? I got to pay that. There is no tax savings, right? So let's take a closer look. We'll just say here, we're going to look at an investment, a $10,000 investment over 28 years with a 7% interest rate with a 25% tax rate, okay? So knowing this is what your account would be worth in doing that. $41,900 in a taxable investment. $49,866 in a tax deferred investment is what your monies would be. $66,488 in a tax-free investment. Okay, so this is all showing us exactly what it would look like when we're able to, take a look and understand exactly the different ways assets can be taxed, and getting started taking advantage of them early on in life is a really good way for us to make sure that our retirement is going to be what we want it to be when we get there. Okay, so step 5 would be risk. We don't want to lose a lot of time. You don't want to take, a lot of time of work in doing this, right? So risk. What is the potential risk in all of this? Your potential risks are taxes, market, the inflation, emergencies, disability, lawsuits, fraud, outliving your money, and death. Did you know that by having a life insurance policy, if we say cash value policy, let's just say that, you are able to be protected from these things, such as taxes, the market, inflation, emergencies, disability. Again, we were speaking of those things within the life insurance industry that you don't have to die to use. Well, these are called the accelerated death benefit options, okay? These are things that can actually help with. Disability. If you have a chronic terminal illness, those things, you're able to basically use your life insurance in order to take care of that. If you need long-term care, that's something that you would be able to use your life insurance policy for. And we'll go a little bit more in depth with that as well. Protection against lawsuits. If you have your monies parked into a cash value or a life insurance policy with its cash value, which we will show you how to do that, it can't be touched. Government can't take it. It can't be drafted. I mean, you're protected from it. No one can come in and say, well, they got to pay us out of this money. They can't do that. It's protected against fraud, outliving your money. You cannot outlive it. And then the death, it's going to provide a tax-free death benefit for your family in the event that something were to happen to you. So in the event of your death, you would have that, your family would have that death benefit tax-free. Okay. All right. So the big picture in all of this is just basically knowing where you're going and how to get there. If we know that we're going to say go to Florida or Maine or California, we can take different routes to get there. But we have to know where we're going in order to know what route to take. So it's important to take a look at the big picture when you're trying to get out of debt. A lot of people cannot retire because of debt. A lot of people are not able to build or start building legacies. We all say we want to build a legacy, but oftentimes it's hard for people to do that. Why? Because of debt. And so that's what we're here, is to show you and to give you a blueprint in helping you, again, redirect your funds, redirect your monies, so that we can help you to get out of debt in 9 years or less without you spending any additional monies, again, than what you're spending right now. So it's very important, and you have to understand and ask yourself, what is your definition of retirement? Because to me, retirement means unemployed. I'm not working unless, I just want to go and just say hello, nothing against the people that are doing the greetings, but I would rather that be a choice that I have versus a necessity. Okay. And then I want the age that I want to do that. I want that to be my choice as well. Right. So you might remember us talking about Mark and Joyce. Okay. Once we went through this with them, and we were just basically explaining to them how they could get out of debt and how they can save the monies and where they would be within this time frame, they jumped on board right away, because we were able to show them that. We were able to provide them that money. And then we discussed with them the 3 phases of money. Okay. Basically, you want to put your money you're putting a plan into place. Okay. So the 3 phases is maximization, make the most out of every dollar. Okay. Accumulation. We want you to learn how to use every dollar twice. And distribution. Enjoy a worry-free retirement. And our plan is designed to address all 3 phases. Okay. So again, the big picture, what are the benefits? Here we are. People argue less about money. We find wasted money, and they find wasted money. We improve cash flow, dramatically increase your savings, help you get out of debt faster than you ever thought possible. Teach you and learn how to prioritize your accounts, and then ultimately retire with a tax-favored income. Now, most people see this and immediately make a decision like Mark and Joyce. And we're asking, would that include you? I know it did for me and my family. So let's review. Step 1 again was knowledge. Step 2 was to improve cash flow. Step 3 was to reduce debt. Step 4 was to reduce taxes. Step 5, minimize the risk. And step 6, the big picture. So you say, well, I thought there was 7. There is. The 7th one is your decision. A goal without a plan is just a wish. So remember that. A goal without a plan is just a wish. So the next steps in all of this is for us to get together, gather some information, personalize it to you for your big picture report, provide you with an analyzed data and run the reports with your numbers, and schedule a follow-up meeting, which is basically going to be the big picture again with the report meeting, and showing you how to get out of debt. Those are the 7 steps and what's needed for you to become your family bank. Okay, so that's the end of that presentation. And what I'd like to do is, like I said, I know that we discussed very lightly as it related to the accelerated death benefits within a life insurance policy. And so I'm going to go over some of those with you, and I'll put those up here as well. So let me put this over here. Just bear with me. Let's see if I can blow this up for you all. And we will get that done. Just bear with me here. Okay. So let me see and know if you all can see this. I hope that you can. It keeps
Yes,
doubling,
see
making
that.
double screens on me. Can you see this?
Yes, I can see it.
Perfect, perfect. So again, insurance that you don't have to die to use, right? So critical illness. Critical illness includes things such as ALS, Lou Gehrig's disease, aortic graft surgery, and then just hitting on some key elements here: aplastic anemia, blindness, cancer, cystic fibrosis, end-stage renal failure, heart attacks, heart valve replacement, major organ transplants, motor neuron disease, stroke, sudden cardiac arrest. So those are the things that would be included as it relates to a critical illness. If you were to come down with those things, or the doctor said that you have those things, these are again items that you're able to contact the carrier and say, hey, I've been diagnosed with a critical illness. I would like to get a second opinion. Or, hey, if I only, have X amount of time to live, I'd like to take you're able to contact the carrier and get a portion, if not all, of your death benefit, if that's what you choose to do. Terminal illness. And again, you see here, generally, if a physician has diagnosed you with a terminal illness that will result in death within 24 months of with certification of one of these illnesses, then you're able to basically, again, access funds from your death benefit while you yet live. Critical injury includes things such as coma, paralysis, severe burns, traumatic brain injuries. So those are the things that you would be able to see and to be able to use those things. And again, a chronic illness as well. All right, so you have your chronic illness. A doctor basically has certified you within the past 12 months that you're unable to work or unable to perform 2 of the 6 activities of daily living for a period of at least 90 consecutive days without assistance, or that you're cognitively impaired. Activities of daily living you see here are things such as bathing, continence, dressing, eating, toileting, transferring. So those are all added into a life insurance policy at no additional cost to you. Definitely reach out to me and we can go over exactly which policies those would include. And I want to thank you all. And I want to thank Rosalind for inviting me. And hey, I look forward to working with you all very soon.
All right. Well, definitely let us know if you have any questions out there. I know we covered a lot of information just throughout the spreadsheet in and of itself, or just as we're looking at through the PowerPoint presentation in and of itself. Sharon, one thing I would say is, how does someone determine if this makes sense for their situation or not?
All right. So what they're able to do is, if they were to contact me, and like I said, we will basically get together and go through their numbers, because everyone is different, right? So what we will do is we will basically sit down, and our first meeting would maybe take us anywhere from 15 minutes to maybe 20 minutes, just long enough for us to just kind of discuss it one-on-one. And then you will know at that point, hey, this is something that I'm even more interested in, that my family and myself, we're willing to move to the next step. Also, with that first meeting, they will be provided what we call a data sheet. That data sheet will ask them to complete that, and that will ask for their real numbers. And with that, I'm able to get back with them within 48 hours or 48 business hours to give them an actual roadmap and an analysis that will show them exactly how they're able to get out of debt within 9 years or less. And also, we would be able to find, by just getting that data sheet back from them, we will be able to see where they are basically, like I said, throwing away monies unknowingly or unnecessarily, and help them to redirect those funds.
And I guess another question would be, I know a lot of people have term or whole. What type of insurance are we talking about? Is this universal life? Are there certain types of insurance that this works with and certain types that it doesn't?
Great question. There are only 2 life insurance when it all boils down to it. It's either term or permanent. Now, whatever tags you add on to those are different, right? So for this particular product, it would work with a permanent insurance, meaning like cash value or an index universal life policy. So even though you have these names, index universal life or cash value or whole life, those are all considered permanent insurance, right? It's insurance that's designed to cover you for the rest of your life, kind of like you're purchasing a home, right? You're buying that. Term, on the other hand, it's going to be it's temporary. It's term insurance. It's for a certain amount of time, right? So those policies would be more or less like you're renting. It's for a certain amount of time. It's you saying or you agreeing, okay, I only want this policy for this length of time. And then of course, once the term policy ends, and you're basically at that point where you're renewing it. And of course, your premium at the time that you renew it is going to be based on your age and everything at that point, at that renewal point, which means your premium is definitely going to go up. Whereas with a permanent policy, your premium stays level and it's the same. But there are more avenues, there are more things that we can actually do, and it has a whole lot more flexibility when you're dealing with a permanent policy. So for
Now,
this particular product, I'm sorry.
oh, I was going to say for people who may say they're uninsurable. So unfortunately, I'm sure people have some instances in their life, things that have gone on, and maybe they couldn't pass a health screening. Is this going to be something that they could take advantage of or not?
Well, if they can't pass the health screening, or they don't qualify, say, for underwriting as it relates to just a regular permanent policy, then there are other avenues that we could take. But if just to kind of answer that in a whole, no, they would not be able to do this if they can't qualify. However, like I said, there are other options and avenues that we would be able to look at to help them do this. So again, that would be more of a one-on-one conversation that I would need to have with that person. If they feel like they have some health challenges or things that have happened, there may be other avenues and ways that we can assist them with, so that they can take advantage of this program. If it turns out that they just don't want to go that route, or they're not able to do that, then there are plans in place. You do have your final expense policies. We still want those people to get covered, and you still have your term policies. But then there are also other carriers that we work with that we're still able to get them coverage, so that their family, in the event something were to happen to them, would still be taken care of. They would still have peace of mind and protection to provide to their family. So we're still in the business of making sure that we can provide those people with peace of mind and also protection for their family, so that their family is able to mourn and not have to worry about how are we going to pay for the funeral? How are we going to pay for the debt that they've left behind? So we still want you to come to us and allow us to be able to assist you.
All right. I think that's pretty good information. It must be thorough enough, because we don't have any questions in the chat just yet, but definitely you have your information in terms of your email, your cell phone, and so forth. So as people have any questions, it may be about your particular situation, or maybe you have other insurance policies, and that might be a question too. If someone has insurance, can they already use what they have today in order to do a plan like this?
If it's something that they already have, it's, again, every situation is going to be different. It's something that what I would rather do is to get with that person and to find out what type of plan, what type of policy do they have, how we would be able to perhaps take advantage of that policy. There may be funds in that policy that we can help them find, monies that may be sitting there that we could actually help them show how to redirect those funds as well. So we're here to work with every individual as it relates to their unique situation.
Perfect. That's so thorough in terms of your options. Having another thing in terms of another avenue that you can utilize life insurance. And so I know a lot of people are thinking, well, goodness, do I need one thing or another? So it's great just to have some options as you evaluate what makes the most sense for your individual situation.
Absolutely.
Any closing remarks, Sharon?
I just want to say, again, hey, I'm here to help you. I'm here to answer any questions that you may have. And I want everyone to know that, there is something for everyone. We just have to figure out what it is that we want, allow us to help you. And if you have a goal, we're here to help you reach that goal. But the first step is up to you.
Well, perfect. Great information as usual. I think one of the biggest things is when we talk about your direction that you're looking to go. And step one is always just figuring out where you want to go. And we always want to be able to provide you some actionable insights that you can use. So step one is figuring out what you want to do, what direction that you want to go in. And once you do that, you'll have the opportunity to use a number of the resources and a number of the professionals that we have brought to you on a week by week basis to complete the objectives of your goal. So, as always, I want to thank you so much for joining us for another Great Money Monday. If you have any questions, Sharon's information is on the screen. So, please be sure to reach out to her. And in the meantime, please chart your own path on your wealth guide journey, and then make sure that you join us for the next Money Monday. Thank you again. My name is Rosalind Brown.